Welcome to the Deep Dive, where we meticulously go through your sources to extract the most important nuggets of knowledge and insight. Today, we're embarking on a journey into the remarkable investment wisdom of a true legend, Peter Lynch. Specifically, we're looking through the lens of his seminal work, Beating the Street. Our mission right now is to unpack how individual investors like you can truly level up your performance, potentially even rivaling the so-called market experts.
That's right. It's a fascinating deep dive into the mind of someone who achieved, well, unparalleled success in the investment world. Peter Lynch famously managed the Fidelity Magellan Fund for 13 years, from 1977 to 1990. During that period, it wasn't just a successful fund. It was the top-ranked general equity mutual fund in the entire nation.
Wow.
And to give you a concrete sense of his impact, imagine this. If you'd invested just $1,000 in Magellan back in '77, by the time he stepped down in 1990, that original $1,000 would have mushroomed into an astonishing $28,000. It's really a testament to his unique approach.
That's just an incredible track record. So his book, Beating the Street, it isn't just a memoir then, it's more like a practical guide.
Exactly. It's packed with insights. Everything from, how to construct a robust mutual fund strategy to his specific step-by-step methodology for picking individual stocks.
Okay.
But maybe more importantly for us and for you listening, it lays out a clear path for the individual investor to genuinely improve performance. It's about empowering the everyday person.
So let's start with the man himself. This incredible success with Magellan. What was the driving force behind it? And maybe even more intriguing, why did someone at the absolute pinnacle of their career decide to, step away from such a demanding role?
Well, what's truly fascinating here is how his personal journey, his evolving perspective, really shaped his decisions and ultimately his investment philosophy. Lynch explains that by the mid-1980s, the sheer scale of the Magellan Fund had become immense.
How big are we talking?
Its assets ballooned to $12 billion, which he vividly compares to the entire gross national product of Ecuador at the time.
12 billion. That's huge.
Yeah, and keeping track of so many companies, hundreds, maybe thousands, it began to take a significant toll. He humorously recounts confusing, complex financial institutions like Fannie Mae, Freddie Mac, and Sallie Mae with members of his own family.
I can imagine.
Or, remembering 2,000 stock symbols, but completely forgetting his own children's birthdays. It really painted a clear picture of the mental burden.
That really hits home, because what he realized next is so relatable, especially for anyone grappling with a high-pressure career. This profound awakening about work-life balance.
Exactly. He shared this powerful, almost sobering anecdote about turning 46. That was the same age his father had died, and that milestone just made him feel acutely mortal.
Oh, yeah.
He recalled that timeless sentiment. Nobody on his deathbed ever said, "I wish I'd spent more time at the office." He just desired to see more school plays, attend more ski meets, cheer louder at soccer games. He recognized that his children, age 15, 11, and 7 then, actually needed more attention as they navigated adolescence, not less. It was a real moment of reevaluation.
A pivotal moment.
It absolutely was. And this raises an important question, really, about how personal values can, and perhaps should, intersect with investment decisions and career paths. He was even offered a chance to manage a smaller $100 million fund at Fidelity, but he turned it down.
Oh, really? Why?
His reasoning was clear. He felt it would still demand the same all-consuming amount of work, just on a different scale. He likened his situation to a tragic Tolstoy story. But a farmer offered all the land he can encircle in a day, and in his desperate attempt to maximize his incredible opportunity, he runs himself literally to death.
Oh, wow.
Lynch hoped to avoid that kind of ending, prioritizing a richer, more balanced life over just endless financial accumulation.
Okay, so moving from his personal life back to his investment philosophy. One of Peter Lynch's most empowering takeaways is his unwavering belief in the individual investor. Now, for many, it's hard to believe a do-it-yourself approach can genuinely beat Wall Street. He challenges that directly, right? What's the core of his argument that an individual can actually have a significant edge over the pros?
Well, his argument is quite elegant, really. Lynch contended that individual investors possess a natural, inherent advantage by leveraging their everyday observations, researching companies they already know and understand, and identifying great businesses that Wall Street might have overlooked or just can't pay enough attention to. They can achieve remarkable results.
Like seeing things the experts miss because they're too focused on the big picture.
Exactly. He pointed to the remarkable record of local mutual savings banks and S&Ls as powerful evidence. This kind of neighborhood investing deeply connected to observable local economies, it consistently pays off. It's about leveraging what you know best.
And he doesn't just offer theories. He backs this up with a truly surprising example. The St. Agnes School in Arlington, Massachusetts. Imagine this. A group of 7th graders with a theoretical $250,000 portfolio. They managed a 70% gain over 2 years.
70%? That's amazing.
Right. To put that in perspective, the S&P 500 returned 26% over the same period. And these students, using basically common sense, they outperformed 99% of all equity mutual funds. It really makes you think.
Absolutely. Their teacher, Joan Morrissey, she divided the class into teams, and their methodology was refreshingly straightforward. Just simple observation combined with basic common sense due diligence.
Like what? What did they pick?
Well, for instance, they picked Walmart after watching a video about Sam Walton and understanding his strategy. Going into smaller towns with little competition. They chose Nike because, well, they owned many pairs and found them comfortable and durable. Personal experience. NYNAX and Mobil were selected for their excellent dividends. Food Lion, Inc., for being a visibly well-run company with high return on equity. It powerfully illustrates that you don't always need sophisticated financial models. Basic, everyday research can be incredibly effective.
So pulling this together, what does this foundational perspective mean for you and your overarching investment strategy? Peter Lynch is incredibly direct about one fundamental principle, isn't he?
Oh, very direct. His core message, distilled down, is refreshingly simple. Buy stocks. And he presented compelling long-term historical evidence. Over 70 years, stocks returned about 10.3% annually, compared to just 4.8% for long-term government debt.
Big difference.
Huge. And the reason is clear. As companies grow, innovate, become more profitable, their stockholders directly share in those increased earnings. Often through rising stock prices, sure, but also through increased dividends.
Okay, that makes sense for growth. But what about income? Many people think bonds are the only way to get steady income, especially later in life. Did Lynch address that?
He absolutely did. He used a powerful thought experiment. Imagine a $100,000 investment over 20 years. If you put it all in stocks, it could potentially grow to, say, $349,140. Plus, you would have received maybe $146,820 in income dividends along the way.
Wow, that's significant income.
Exactly. Now, contrast that with $100,000 entirely in bonds. You get maybe $140,000 in interest over that same period, but at the end, you just get your original capital back. No growth on the principal. The capital growth from stocks plus the significant dividend income, it just far outstrips the bond scenario in his example. He really wanted to hammer home that stocks aren't just for growth. They can be excellent income generators, too, long term.
Okay, but this raises the big question. What about the perceived safety of bonds? We're always told they're the safe option. Lynch disagreed.
He argued that perception of safety is often, well, a fallacy, especially when you factor in inflation and purchasing power. A 30-year Treasury bond, for instance, is only truly safe if inflation stays really low. But if inflation spikes to double digits, like it has sometimes, an 8% bond's resale value could plummet by 20–30%.
Because newer bonds would offer higher rates.
Precisely. He used the example of the 1992 dollar being worth only a third of its 1962 ancestor. Inflation just erodes the real value of fixed income. And bond funds don't protect against rising interest rates either. When rates go up, existing bond values go down. So his advice was quite bold. Increase your stock allocation to the absolute limit of your personal tolerance for volatility, because that's where the real long-term returns and inflation protection lie.
Given that strong emphasis on stocks, what about market corrections? Those downturns can be incredibly scary for people. How did Lynch view them?
He had a very clear, very pragmatic view. Stock market declines aren't anomalies, they are routine events. He called them as normal as frigid air in Minnesota.
Good analogy.
The crucial factor during these times, he emphasized, is your stomach, not just your head. Meaning your emotional fortitude, your ability to ignore the daily worries, resist panic selling, keep that long-term perspective.
Stomach over brain, I like that.
Yeah. He noted Magellan often sank deeper than the market during corrections, but crucially, it always rebounded higher. These periods, he believed, weren't times for fear, but a great opportunity to pick up the bargains left behind by investors who are fleeing the storm in panic.
So corrections are basically sales, opportunities to buy good companies cheap.
That's exactly how he saw them.
So how did he practically identify those bargains then? What was his research process like beyond just looking at the numbers?
Well, he details a remarkably rigorous, yet very hands-on research process. It often involved what he called taking a corporation to lunch. Fidelity, his firm, would regularly host CEOs, CFOs, investor relations folks, he found they were generally objective, candid about their operations, providing insights you just don't get from reports.
Talking directly to the people running the company?
Right. His personal rule was at least one conversation per month with a representative from each major industry group he followed. And a particularly insightful tactic. He'd always ask CEOs which competitors they respected most.
Oh, interesting. Why?
Well, that often led him to research and ultimately buy that rival company's stock. He figured insights from a competitor were highly credible. He also famously advised against staring at Quotron screens all day, those old stock price terminals. He preferred the older blank screen.
Really? To avoid the noise?
Exactly. He wanted to focus on the business fundamentals, not the daily ticker fluctuations.
Okay, so Lynch had this knack for finding value in unexpected places, often where others weren't looking. What were some of his favorite hunting grounds?
He famously championed finding great companies in lousy industries.
Lousy industries, why?
The core insight is counterintuitive. A flashy, fast-growing industry often attracts too many competitors, right? Which ultimately dilutes profits for everyone. But in a slow-growing, often boring or even disliked industry, weaker players tend to get weeded out, leaving the resilient, well-managed companies to gain market share and thrive with less competition.
So less competition means better potential profits for the survivors.
Precisely. It's about looking past the industry's surface appeal to the underlying business strength and management quality. He believed the lack of attention from Wall Street kept prices low, creating a big advantage for investors who did their homework.
That's great contrarian thinking. Can you give us a few examples of these lousy industries where he found gems?
Absolutely. Think about the airline industry, historically terrible for investors.
Yeah.
Yet, Southwest Airlines thrived. Why? By not doing what others did. No fancy meals, sensible borrowing, fair executive pay. They focused on efficiency.
Okay.
Or Nucor, the steel company, another classic lousy industry. Yet its stock soared over decades because it was a lean, innovative company with profit sharing and efficient mini mills. He also mentioned Bandag, a retread tire company. Another unexciting business, but very successful, proving strong management matters.
That focus on overlooked areas extended closer home too, right? He liked regional banks.
Yes, regional banks were another Lynch favorite. He noted they were often ignored by the big investment houses focused on national players. Despite this, these banks often had consistent 15% annual growth rates, yet traded at really low PE multiples, like 7 or 8, compared to the S&P's 23 back then.
So good growth, cheap price.
Exactly. He invested heavily, saw companies like Wachovia, MBB Bancorp increase tenfold. Local, understandable businesses simply ignored.
And perhaps even more intriguingly, especially after the S&L crisis, he found opportunity in savings and loans. He called it, "It's a wonderful buy." Why?
Yeah, his contrarian approach really shines there. He famously said, when even the analysts are bored, it's time to start buying.
Yeah.
After the S&L crisis, these institutions were just reviled, ignored. For Lynch, that's spelled opportunity. He focused on the Jimmy Stewart S&Ls, the conservative ones, mainly doing residential mortgages, not risky commercial stuff, looked for low PEs, minimal high-risk assets, just well-run conservative banks poised to recover.
And he even outlined what he called a can't-lose proposition almost, with S&Ls going public. Explain that.
Yeah, this was a unique, though temporary, situation. Many S&Ls were mutually owned by depositors. When they converted to publicly traded companies, they sold shares. But because they were often undervalued, their book value assets minus liabilities effectively doubled overnight when they went public.
So you were buying assets cheap.
Right. You could potentially get $20 worth of assets for $10 a share right at the IPO. He found in the early 90s many of these generated huge gains. Some were 10-baggers in under 3 years. Now, he did note a moratorium stopped this due to insiders gaming the system, but he thought the opportunity might return with better rules. Classic Lynch finding a structural edge.
Fascinating. Beyond banks and S&Ls, what other less obvious sectors did he like?
Another area was master limited partnerships, MLPs. These trade publicly, kind of like stocks, but have partnership tax structures. Despite some nuisance paperwork and being unpopular, which crucially keeps prices down, they often do down-to-earth stuff like pipelines. And they distribute nearly all earnings as high dividends, often tax-advantaged. Another case of value in unpopular income-generating vehicles.
Okay, and what about cyclical stocks, like automakers or mining companies? Their earnings are all over the place.
With cyclicals, Lynch famously flipped the usual advice. You don't buy when earnings are high and the PE is low. You buy them when earnings are low and the PE ratio is high, precisely when everyone else is pessimistic.
Totally counterintuitive.
It is. The key is understanding the cycle, buying near the bottom, and anticipating the inevitable upturn. He detailed doing this with Phelps Dodge, the copper company. He looked beyond copper prices to their other businesses, cash flow. Seeing value others missed, trusting demand would eventually return, requires patience.
And for the really brave, he talked about nukes in distress, troubled utilities. What was that strategy?
Yeah, perhaps his boldest contrarian play. The strategy was simple, but needed guts. Buy these troubled utilities when their dividend is cut or omitted due to some major setback, like a problem nuclear plant. Then hold until the dividend is eventually restored. He claimed this had a terrific success ratio.
Buy when the news is absolutely terrible.
Exactly. He used CMS Energy as an example.
Mm-hmm.
Suffered hugely from an idled nuke plant. But he saw rising electricity demand in their region, other projects. He bought at the absolute bottom, waiting for the fundamental strength to win out.
Finally, what about something common like restaurant stocks? He saw potential there too.
Oh yeah, he called restaurants a continuous source of great growth companies. He noted they have a kind of natural protection because it takes a long time for a chain to expand nationwide. More predictable growth than, say, tech. His key advice here: avoid companies that expand too rapidly. He pointed to Fuddruckers, which ran into trouble opening over 100 new places a year.
Too fast.
Way too fast. Compare that to Chili's, which maintained a sensible pace and had consistent success. It was about measured, intelligent growth, not just growth for growth's sake.
We've covered so much ground today, from his personal journey to specific strategies. To bring it all together, what are the big overarching principles Peter Lynch wants to leave us with?
Yeah, he really distilled his philosophy into several key, actionable principles that are still relevant. First, diversify your funds. Simple, but crucial. Divide your money among 3 or 4 types of stock funds: growth, value, maybe international, so you always have something working, whatever the market's doing.
Then put all your eggs in one style basket.
Exactly. Second, invest in lagging sectors. When adding money, consider putting it into the fund type or sector that's been out of favor for several years. Classic contrarianism.
Buying low, essentially. And building on that, his third principle challenges a common mistake. Don't chase past performance. Right?
Trying to pick tomorrow's winner based only on yesterday's results is, as he put it, futile and expensive. Last year's top fund is rarely this year's top fund.
Okay.
Fourth, embrace corrections. Remember Minnesota. A market decline is routine, an opportunity to buy bargains from panicked sellers, which leads right to his fifth point. It's about your stomach over your brain. Everyone has the intelligence, he thought, but not everyone has the emotional fortitude. If you know you panic sell, he advises, maybe stocks aren't for you. It's about knowing yourself.
That emotional discipline seems key. His sixth principle is simple. Be here now. What did he mean by that?
Basically, treat each potential investment as if it had no history. Don't get hung up on what the price used to be. What matters is the stock cheap or expensive today, based on its earnings potential now and going forward. Forget the past noise.
Focus on the present value and future potential. Makes sense.
And finally, his seventh, maybe most fundamental principle. Stay engaged with your companies. Owning stock is owning part of a business. He compares it to owning a rental building.
You wouldn't just buy it and forget it, right?
No, you'd check on it. Exactly. Check in periodically on your stocks. Understand new developments. Are the reasons you bought still valid? It's an ongoing relationship, not a one-time bet.
It's really clear that Peter Lynch's insights go way beyond just numbers. They're about understanding the world around you, using common sense, and having the right mindset. And his personal story, stepping away from billions to focus on family, that really underscores that the best returns aren't always financial.
Indeed. His message is ultimately one of empowerment for you, the individual investor. He reminds us that our unique observations, our local knowledge, our understanding of maybe a boring industry, that can give us a real edge over the professionals on Wall Street. Sometimes understanding your local S&L or why a restaurant chain is doing well is more valuable than complex models.
So, after this deep dive into Peter Lynch's Beating the Street, what stands out most to you? Perhaps now you'll start looking at your own neighborhood, your favorite stores, even those industries everyone else dismisses, with a completely new investment lens. What lousy industry or maybe overlooked neighborhood gem might you uncover for your next smart investment?